Appreciate you guys getting on today. What I want to get into, kind of what you saw titled tax management strategies. And what I want to get into today is I'm on the investment side. I am not a tax professional. I'm not licensed up in that area, but like a lot of you guys, I'm sure, if you have an interest in your own portfolio, you kind of have an interest in trying to do as much as you can and limit your tax liability if that's the case. So you end up learning some by default. So I have a pretty good understanding of some basics. And so this is an effort to equip you guys or equip my client base, prospects, anybody else to put it out there. So that's an effort of this, is just to equip people. And basically, if the sharper you are with your portfolio, the sharper you're going to end up being having a conversation with somebody who might be proposing you a product, or somebody who maybe has questions about their portfolio, and you're going to have a higher understanding and be able to help them. So ultimately, that's a huge deal, because that's what happened to me. My advisor coming up, she did a great job with me and learned me up as kind of happenstance. And so I became a lot better equipped to be able to make some of those decisions and ask a whole lot more pointed questions. And so it's really good. So that being said, today is going to be it's going to be really high level. Not going to be diving down into tax code or anything, but just some things that we're going to be looking at, a little bit about Tax Cuts and Jobs Act, with just flavors of potentially what's coming, because we only have proposals right now, and nothing has been set in stone. That's with the new administration. But some current tax deals were going on. What things do we look for in our investment vehicles potentially to help that, and then a couple examples of that. And so that's what we'll be going over today. But we'll be getting going. And so let's get rolling with that. Just a little bit of background on me. A lot of you guys know I've played 6 years in the NFL. Was great. Had a great experience there, and loved that. But a lot of people, it was funny, you think that might be something that might help a person out in their business. Well, a lot of people were like, I don't need an NFL lineman, I need a financial advisor, right? And so what qualifies you to have this conversation to me? And so with me. And so, what I say there is the same thing I'll say to everybody is, I'm not perfect. I don't know everything by any shot, but I tell you what, I have a lot of life experience that has proven great, and good and bad, so I'm sure a lot of us can speak to. But a lot of great has really stacked on. And so what that has come to is, I'm 10 years removed from the NFL, and because of those lessons I've had, some good decisions that we've made, I'm a lot better off today than I ever was playing ball. And so, and I had to walk through those personally, and through my family. And so it's put me in a really great place. So that's what I try to do here, is share what I know, what I learned, and see if we can't hopefully replicate it, right? We can't, historical performance doesn't produce anything in the future. We don't know for sure, but we can go sure as heck try. So that's what I'm going to do. But if you guys you have to jump off at any time. I wanted to put my contact information up here just so you had it. You can snapshot it on your phone if you're watching, or just take a screenshot on your computer. Check out the site. It's got a lot of information on there. I'll give you guys a quick tip though. You see my family photo. On a scale of 1 to 10, if you measure yourself a 5 on looks, when you take pictures, you need to surround yourself with 10, right? Because all of a sudden, that brings your level up to an 8. Perspective, baby. And so you'll see, I got my wife, Megan, our daughter, Grace, who's 6, our son, Hank, who's 15 months, destroying my house right now. But I'm pretty lucky to be where I'm at. Thankful here in DFW, Trophy Club, Texas. But just some information there about me. And I work as an independent advisor, a broker dealer through Woodbury out of Minnesota. Pro Capital Wealth Management is my DBA and my LLC, my business. So I own that and operate it out of the house here, and ultimately growing my team. So good place to be. A couple notes. If you guys have questions, use the Q&A box and then I'll get to those at the end. I'll allow a little bit of time at the end for this, but just for sake of time, so we don't go off the rails, because I have a tendency to do that plenty, to keep myself in line. Go ahead and put your questions in the Q&A box if you got any. And after we're done today, I'll download the webinar and I will email you guys all out a link that you can watch it if you need to rewatch it again or want to go over questions. I know there's some people that couldn't make it this morning, so I always email that out to them afterwards, and I always tell everybody, if you can't make it, just register, and that way you at least get a copy of it, so you can revisit it. And so I'll make a note. Next month's webinar is going to be on estate management, principles of preserving wealth. And I'll tell you, I got my big screen over here and some of my notes, so just in case you guys wonder what the heck I'm looking at, this is what I'm looking at right now. But next month, estate management, principles of preserving wealth, some really important things. A lot of people can think estate and they may only think of the rich. Well, no, that's referring to everybody. Everybody has an estate that they have to deal with, and your assets accordingly. And we got to put that stuff in order for your control and your wishes, and there's a lot of different factors involved in that, but that's next month. So if you're interested in those pieces or something in estate management, go on, same thing, go on procapitaltx.com. That's my site. You can go under the tab events and you'll find a link just like you did for the tax webinar, and you can register there. And I have other events coming up. I do a monthly webinar, and then I have some in-person ones that I do as well. So keep a look out for that. So there's also a ton of information on my site. So you can go to the resources tab. Move this a little bit. You go to the resources tab, and there's a ton of information. If somebody wants to investigate me or investigate some things themselves, there's calculators, there's topics that you can go under and research a ton of different articles, and that stuff is actually refreshed daily all the time. Market news you can go on, so there's a ton of information on there, so go check that out. Some really good tools on there. Last one before we hit it off, take some notes. I'd encourage you guys, I don't know about me, but I have stacks of notes in my drawers, in my cabinet, in my closet door, full, not only from my time playing, but from now as an advisor also. And I'm a note-taking fool, and it has been a really great way to solidify information in my mind, so I can come back and review it. And so this is a great way teaching too. So it kind of solidifies, gets the third step to solidifying information in your head. And so I'd encourage you guys to take notes. It's been a huge tool for me. If you only got your phone, do it on there too. We'll go ahead and get going. So let's start with 2017 was the Tax Cuts and Jobs Act, right? A lot of you guys remember Trump administration came in and totally overhauled this. This was the biggest sweeping overhaul that has happened in 30 years. It was a big deal. A lot of you guys know this already. You get, obviously he has some of his naysayers and some people that don't, some people that say they increase taxes. Well, if you're talking about income taxes alone, I'm going to tell you that's not correct. If you want to go back and compare somebody's return from 2016 and 2017, you can see exactly the difference and what was made and what ended up taking home is a big result. And so, second point, you'll see they cut business tax rates from 35 to 21. The new proposals are looking to go to 28. That's things of note, but it ended up freeing up a ton of cash into the economy for companies to grow, higher profitability, lots of different things. So it infused a ton. So we had a ton of growth in the last 4 years, and this was a big reason for that. So another thing they did there was they repealed the alternative minimum tax, didn't get rid of it altogether, but lessened it. And so that's the pre-2017, pre-Tax Cuts and Jobs Act. We're looking at potentially coming back to that. And what that is, the purpose of that tax was to make sure people in higher income brackets paid a level amount, that we couldn't take itemized deductions and just go crazy with it. And so it ensured a certain tax rate for those folks. The last piece, they placed a big note. They placed a big cap, $10,000 cap on state and local taxes and those deductions. So one big thing a lot of you guys might have seen was property taxes. Somebody might have sandwiched them in the same year to try to maximize that deduction. Well, now that's not possible. So now you'll single it out into the year. Who knows what will come back with the new proposals, the new Biden administration. But that's where it's at right now. So 10,000 was the cap, but you also noticed the standardized deduction jumped way up, and that was actually a big deal. I think almost where it used to be about a 70-30. I might be a little off on that, but it used to be about a 70-30 split in our nation on the standardized deduction versus the itemized deduction. Now the standardized deduction shot up so much, it went to like I believe it's a 90-10, a pretty lopsided deal where 90% of our nation is on a standardized deduction while the other is itemized. And so it was a huge deal, but allowed us to reduce our AGI and ended up being a big deal for us, right? So we'll keep going. Little fun fact for you guys: if you weren't aware already, you are now. The wealthiest 20%, of taxpayers pay almost 87% of all income taxes. Man, I would tell anybody, just kind of take a minute to consider that stat just for a second, and it's pretty staggering. And so, okay, you might ask, like, all right, well, how much? What is that? Who's the wealthy in that case, right? Well, top 20% to qualify for that, you just have to have an adjusted gross income of 112,000, of about that. And so, if you're above that, you're in the top 20%, and you're help contributing to 87% of the total taxes paid in this country right now. So that's a pretty significant stat. So on the other side of that equation, the bottom 80% of all taxpayers pay about 13%, and then the bottom 20% actually have a negative tax rate, meaning they get more money back from Uncle Sam in the form of a refundable tax credit in tax credits than they pay in taxes. So there's actually a negative rate down there. So this is good general information for you guys to have. I think it's kind of, as we go forward, as you kind of make choices on voting later, you vote where you want, but this is pretty lopsided in a lot of ways. But this is why the top class is so important, because I mean, they support us so much in this country that we need that. So moving on, tax burden. So some of you guys might look at your W-2 statements or your 1099 statements or your end of year statement, and you might be looking at this thing and you might be just shaking your head at the amount of taxes that are coming out of your check or that you have to pay back. And I get it, right? There's a lot. We have a whole lot. Most of you guys know about federal income taxes, but a lot of people forget about Social Security and Medicare, which are usually taken out of the paycheck. Maybe self-employment taxes, gift and estate taxes, which are looking to jump up potentially, at least with the proposals of the new administration. Then states jump in there, right? We have state income taxes, sales taxes, excise taxes on gas, tobacco, alcohol, and a lot of other stuff. Then we got local governments to take their share of property taxes and sales taxes. If you're in Texas, you know exactly what property taxes are. Then we have improvement school district taxes, and there's just taxes out the wazoo. And so it can become a lot and a bit of a burden to sit here and look at all this stuff. And so we have to start thinking about this stuff as we're looking at our investments, and potentially what's the ramification of all this, and where can we go otherwise. And then we'll look at some charts here in a minute, but then we got to look at the impact of it, right? And so you look at this one. This is through 1926 to 2017, 92-year period. The average return on the S&P 500 in this time is 10.2. It's about 10.3 right now. But if you're in a taxable account or a non-qualified account, just a retail brokerage, you got to look at how taxes are going to affect this. And so, this was a Morningstar study that was done, but it looked at somebody. Let's see, it was in I think it was a 24% tax bracket. Was my notes here, but it was something about that. I think it was about the 24% tax bracket. But what it looked at was what was my net return after taxes. And so if somebody were to just take this average return net, they were collecting 8.2%. That's what they're making on their investment. And so we got to start looking like, okay, I might have made a 10.2% return on my investment, which is fantastic. I love it. But what's the actual ramification of that? What's the tax ramification? What's our net return? So this is an important thing to look at. And so we'll walk through here these in a minute. We've had, and then over time, this slide here is just the amount of tax laws, major tax law changes we've had since 1940 through 2017. We've had 81 major tax law changes. It's crazy. A lot of you guys know the joke, right? What's the two constants in life? Death and taxes. All right, well, there's one other one. What's the difference between death and taxes? Well, death, you're not worried about when Congress goes into session. So it's if you're always taxes, you're worried about it. They're always looks like they're always wanting to raise it sometime. But there has been a ton of rules added, changes, and so really why I show this is this emphasizes all the previous slides. It emphasizes the attention that needs to be had against the current tax laws and what are the ramifications potentially on your investment portfolio. So that's a big deal. And so if you're not paying attention to it, you know, you might be losing out in some areas where you could have a better return just simply on paying less taxes. But there's different tools to do that. And so, you know, really that's kind of the biggest reason for this presentation altogether is like, look, this stuff is changing constantly with new administrations, new leaders. So it's something that we have to stay on top of. And if you're not staying on top of it, somebody else should. So this is what I take into effect. You guys should be learned up on your end in a big way too. And so moving down the line. So what does that mean? That means when we're looking at taxation on our investment returns, we got to look at, depending on income bracket, depending on goals or the purpose of the funds, we got to look at what are some ways that we can maximize or minimize tax liability and potentially take more home in the end, right? And so we start looking at a few different things. And so in our world, we look at a few different type of things. The tax change investing or tax favored investing that we start looking at typically is in tax exempt or tax free areas or tax deferred investments. And so that can be a lot of different things. And so we'll go through a couple of these here, but listen out just a little bit. Tax exempt investments, municipal bonds. A lot of you guys know what those are. At the very beginning of my journey of investment, I don't know about you guys, but I couldn't even wrap my head around the idea of buying debt from somebody. And so that's exactly what it is a muni bond is state and local governments will issue these bonds where they'll use bonds to finance projects in the city. And this could be a sports complex. It could be a new government building, local government building. It could be roads. It could be a lot of different things, right? But they'll issue these bonds in order to finance those deals. And so you can invest in the bonds. A lot of times the federal government will allow you to get a tax-free return on or tax-exempt return on the interest. That's sometimes the case for some state and local governments too, not always the case. But those can go up and down. The principal that you put into those can go up and down in those notes. But those are potential tools that you'll see used also. And then we can go to tax deferred investments. A lot of you guys will talk about more of this here in a minute. Qualified retirement plans, traditional IRAs, employer plans, 401ks, 403bs, annuities, life insurance. We'll talk about all those here in a minute. But these are all tax deferred investments and tax exempt on the left side here. That these are typically a couple of ways that we try to go right away if we're trying to help somebody minimize their taxation going forward or work towards some specific goal. Keep going down here. We'll talk a little bit here about the muni market. Muni market is massive. And so we've actually seen a big shift into that recently with the anticipated tax increases that are coming in with this Biden administration. Still, those are all proposals right now. Those are all proposals right now. So we haven't We don't know for sure. We can anticipate, but nothing has been implemented yet. So as of right now, we're staying with the current Tax Cuts and Jobs Act, and but we are anticipating some sort of tax increase. But this is potentially a great way to go for several reasons, and we'll look at a couple different slides to show. But municipal bonds, there's one thing to keep a note when you're looking at dealing with bonds. The interest, depending on what the interest rates are, and they have a inverse effect on a relationship with a premium, or excuse me, with a principal on, or the price of a bond. And so what that means is as interest rates rise, prices of bonds drop. And so, and the vice versa, right? So as interest rates come down, prices of bonds go up. So that can affect the investment in a big way. And so potentially, like if you're receiving interest back or dividends back on a bond, the value of the bond could be dropping potentially because interest rates are climbing up. So that's one thing to think about when you're talking about it. But it is a huge market and potential place to look for some tax exempt status. So you might be looking at something like that. There's a couple different types. So there's individual, and then there's bond funds. And so when we start talking about it, I'll have plus and minuses. But as we talk about individual bonds, the nice thing about these is this is basically like you coming into your next door and finding next door investment door and going to the city itself and wanting to invest in these bonds selectively. So this is you doing it. So the nice thing about individual bonds, the positives are the selection. There's tons of them. Self-directed, meaning you can do it yourself. Principal at maturity, right? What that means is you get your money back when that bond matures, or when that note is done. And then there's typically not an annual cost with that. Now, the bonus of a bond fund is, what I like about these are diversification right away, meaning, and liquidity. That's what I love the most about these. Meaning if I'm looking to diversify my assets, I can go into multiple bond funds. I can go into one. I can have multiple bonds in that fund, and have it liquid, or have the ability to grab at that cash if I wanted to, grab at that asset if I wanted to, for any reason. And so it's a little tougher in an individual bond. Excuse me. And to diversify there, you got to go into a bunch of singles. And so it's a little tougher to do that. But just like if you were buying equities, any dollars that you're putting into one equity or one stock or one company, any assets that are in that, all those eggs are in that one basket and relying on that one to perform or not to perform. So they're subject to the fluctuation of that specific company, that company risk. And so similar to that, right? If you put it into one bond, you're subjecting yourself to that one bond and the leadership of that government directing that in the right way, and so in a positive way for you. So there can be, there's a lot of risk, company risk involved in that potentially, and so you can diversify that a bunch by going into a bond mutual fund. There's also ETFs or UITs you can do, but bond funds in general, where I can diversify, I can create liquidity for myself. They typically have low minimums. I've seen anywhere from $100 to $500 for a minimum. You can maintain your risk profile that you're trying to go for. And the nice thing about these, especially with mutual funds in general, is the professional management. There's usually, if I'm in a bond mutual fund, there's a manager specifically who looks over that fund to try to turn those investments as they see fit. And so they're trying to maximize their returns also. But all that being said, all of it's subject to loss. Any investment, we have a potential risk of loss in that. So you got to be aware of that. Of note, just note at the bottom here, you'll see mutual funds are sold by prospectus. So if anybody ever comes at you, know that. So you should be able to, you can get it digitally, but you can get it physically too. It's usually a big old thick book. But you can get along with the fact sheet, but those are sold by prospectus. So that's just a note. When we do this, when we're looking at tax exempt or tax deferred vehicles, or any investment vehicle, really, we got to look at what are the equivalent yields across the board. And so what that means is, say we're coming into a higher tax rate, or coming into a higher tax season, potentially, is what we're looking at with the new administration. And let's say you're in a 32% marginal income tax bracket, and I've been getting 8.82%. You'll see on this chart, 8.82% on my equity portfolio, and you're considering going into a bond portfolio or another one of some place, right? So if I'm considering something like that, going into tax exempt place, well, in order to equal that 8.82%, I got to have at least 6% on that tax exempt yield. And so it's similar, same way the other side. So maybe I'm in tax exempt places or tax free places, maybe in like a Roth IRA or some life insurance we talked about. But if I'm in one of those places, well, my 6% yield, if I'm going to go somewhere else, I got to get at least 8.82 or greater to justify that move potentially, right? Unless you your goals don't align with that. But if I'm strictly looking at investments, those are some things I need to look at. It's like, okay, what's my equivalent in this area to this one to make sure I justify the move, right? So this is a good chart. If you guys are here, you can snapshot this with your phone or with your computer too. This is a good one to keep, just to kind of put that reminder in your head as you move around. Hey, what do I need to do this? And so you can't predict return, but nobody can, right? But when you're outlining your goals, you start looking at different investments or heading to different places. This is a good one to reference when you're doing that. So keep that in mind. Let's go into some tax deferred vehicles, like qualified retirement plans. These are great. Traditional IRAs, max for 2020 is $6,000. If you're over 50, it's $7,000. Now, income limits and participation employer plans apply to this one for your ability to deduct it. So that's a key one. I've seen that a lot with different CPAs or different people. They might be putting into a traditional IRA, and they're not filing the right forms with that to make sure that the deductibility of that doesn't get hit on the back end when they take it out as distribution later on. And so this is an important one to have. A lot of people don't usually know about. So a lot of times people will steer away with it. But on the other side, we'll have our 401k or 403b. For guys that don't know the difference between that, 401k is basically the public sector. 403b is government. So if you have somebody that works as a teacher at a school, or you have a government job, typically they'll have a 403b attached to them, and they're the same thing, just for different sectors. The 401ks for the public. And so max contributions right now, $19,500, $26,000 is the catch up for 50 and up. We're not too late to do that. So if you guys have not made your 2020 contributions, you have that capability, and you haven't filed your taxes, you can still do that. We've been extended, especially here in Texas, after the ice storms, but you can still participate and file your taxes, get that deduction, and reduce your AGI for the year. That ends up being a big tool, right? And so these are really good plans in this. And so one thing to note, a lot of you guys know this, going into a 401k, man, if an employer is offering a match, I still get a ton of these questions. You know, should I do the match or should I not? There's a lot of opinions out there. Or should I participate in my employer program, or should I go into a Roth, or should I go into another place? Well, it depends on the person, right? But in general, when you're talking about an employer match, you're talking about 100% return day one vested on your investment, or 100% return on your investment day one. That is a huge deal. And so a lot of times, if it's part of their goals, I'll direct people and say, hey, I would take advantage of that, because if you're conservatively projecting 6% growth year over year, and I have the opportunity to grab 100% in one day, I'm going to take that every day of the week. So that's a big deal. I would do that. But as we get into more of these plans coming into this slide right here, so same thing on the taxable, on the two slides ago on the taxable equivalent yield, excuse me, we're looking at on these deferred plans. Well, we got to look at what would be the equivalent if I were not to go into that plan. So if I was to invest, what this shows is if somebody's in a 24% tax bracket and they contributed $1,000 into their pre-tax plan and their 401k, how much post-tax money would I have to put in to a non-qualified account or a retail brokerage account or some other investment that's dealt with post-tax money? How much would I have to put in to equal that $1,000 pre-tax money? Well, that 24% tax bracket will be an extra $316. So that would be $1,316 of post-tax money you'd have to put into that to potentially equal that. So that's a big deal. So these are some things to keep in mind. Of note, and when you go into these qualified retirement plans, you got to know that these are deferred till 59 and a half. And at that 59 and a half is when you can start taking distributions from that. And then those funds will be taxable when they come out. At 72, which is a new rule we had, used to be 70 and a half, and now it's 72. If you hadn't started taking distributions from those accounts, the government will require you to do that. It's called RMDs, required minimum distributions, and so you'll have to start taking those out in later time. Another thing of note there, a lot of you guys might have heard of the Stretch IRA. Well, 2019, I believe it was the Secure Act, they did away with that. Used to be a real beneficial thing. So if somebody passed away and handed their IRA off to you, or their 401k or their qualified plan off to you, you could stretch that IRA over the course of your life and really minimize the tax liability on that, which was a great thing. Well, they did away with that at the end of 2019. So now the furthest you can stretch that out is a 10-year period. So if you're somebody that falls in that category, or your kids might, right, if you leave them qualified funds, but the furthest they can stretch that out is a 10-year period now. You can be the judge for yourself on why that's the case. But that's a big deal. And so I will say, if you take these funds out pre-59 and a half, a lot of you guys are aware of this, before 59 and a half, not only will you have to pay taxes on it, you will be subject potentially to 10% federal tax hit. That's if it's not used for a qualified distribution. There are qualified ones. First-time house, it was introduced up to $5,000 for adopting a child, and there's some medical qualified expenses also. But if you want more information on there, irs.gov is a good place to go to find that stuff. But they're good plans, but they have rules. So you got to be able to know those rules before going in, and make sure you're well versed in that before getting into it. But these are some good options you might potentially be looking at. Let's see, tax advantage of tax deferred options. So we went over this a great degree. Depending on your capability and your current situation, right? Some people might have debt, some people might not. Some people's income this last year, especially with COVID, some income went down, some went way up. And so everybody's kind of in a little different bucket. And I would say, if you're one of these people who are maybe you're higher income, maybe you're trying to lower your AGI on your tax return, or you're trying to get accelerated growth for some reason, you don't want to realize capital gains. I would look at potentially maxing out your employer plans or your 401ks or any other qualified plans you might have. So contribute as much as possible. Obviously, try to get those matches if you can, because at the end of the day, our max to contribute to a 401k right now is $19,500. That means I could deduct $19,500 off of my taxable income for the year, and that ends up cutting that liability down and being a big thing. And so another portion of that you could look at going into IRAs, traditional IRAs. That's based off income. Can have income caps. The deductibility can have income caps on it, thresholds, as well as participation in an employer plan. But again, you got to make sure your CPA is filing the right documents to make sure that that principal doesn't get taxed on the back end. So that's an important note. Roth IRAs, I always love the great tools. I'd like to exercise any sort of tax exempt or tax-free status that I can, but that has income limits. So it's about 200,000 right now. So if you make over that, you can't put it in your Roth, unless maybe you look at doing a backdoor. That is an option, but in general, we can't just deposit right into or contribute right into a Roth IRA. But those are always great. If you're under that income limit, those are always great deals, because ultimately, if you have lots of years of deferral for growth, that grows tax deferred, and then potentially take withdrawals after 59 and a half tax free. Of note, you do have to, if you start a Roth, you have to be in it for 5 years before you can do that. So start it early on before you need it. And then you can always grab at the principal if you ever need it, since it's post-tax money. So those are good notes there too. Let's keep moving on. Types of annuities. Annuities are different tax deferral options too. There's basically two different types. There's deferred annuities and immediate annuities. And so you can have a mix of them, but deferred annuities have an accumulation phase. Basically, what you might be saying is, hey, I want to put more into retirement, or I want to get past a higher taxable portion in this life, or maybe I want to minimize my tax hit right now, and so I need to go to a place where this is deferred. I don't have to worry about it until it comes out, until I take it out. So annuities are great choices for these two. Deferred annuities, variable annuities, you have to have a securities license to sell those. Those deals with market returns, so you can have a bunch of sub-accounts, mutual funds and sub-accounts. And then there's a lot more conservative ones. Fixed annuities fall in that category. But you can have an accumulation phase where ultimately you have a payout at some point. And then immediate annuities are basically, these are all insurance contracts where I can put in my principal or my premium and have an immediate payout. And there's lots of different types of contracts, but as we get into these, there's a lot of benefits to them also. And so as we look at those, when we look at different annuities, here's just an example of a combination of a immediate and a deferred annuity. And so where this might be somebody closer to retirement where, or in retirement where they're like, man, I need income now. And so I might do an immediate annuity to have a payout monthly, quarterly, or yearly. But I want to anticipate for inflation, or I want possible market return. So I'll go into a deferred annuity until a later time when I need that income. And so in this example, what it shows is, this shows a 10-year immediate annuity contract, and then paying out for that time frame, and then putting the rest of their principal, the $74,000, into a deferred annuity, growing at, this is super conservative, at 3%, growing at 3%, and then taking out income after that 10-year contract is out. So this is just an example one. There's lots of different types, just so you guys know. When you're looking at these things, you want to be aware of, just like any other investment, what's my expenses, what rules am I playing by right here, what's the potential solvency of the insurance company, are they reputable, and what are all the pieces of those contracts. And so you want to be aware of those for sure. You can hold an annuity in an IRA. This sounds a little redundant, right? Why would I go tax deferred vehicle into another tax deferred vehicle, you might ask? It's a good question. It's a real question, because the only reason you would do that is because in those annuity contracts, you can add riders, you can add guarantees onto those things. You can add death benefits. So maybe, let's say you don't qualify for any life insurance. There's possibility that you can do a variable annuity, or an annuity with a death benefit rider on there, where it maximizes the value of the contract in case there's potentially a market loss. That way, whoever my loved ones are, whoever it gets left to, has a maximal return on that. And so, that's a big deal. There's income riders you can add onto these. There's guaranteed annuities that you can have that guarantees an income source for life. I'll tell you that becomes a deal because longevity, because the longevity is a risk. We run the risk of going into retirement and running out of money. And I don't know about you guys, but I don't want to go back to shaking hands at Walmart. And so I want to make sure when I cross that veil, I stay there, right? So there's benefits to having that, right? But considerations you list here on this is the cost. And when you do go into an annuity, it's not like there's any additional tax savings. They're just deferred vehicles. You want to maximize that potentially. I will say annuity contracts and life contracts are protected by the state from creditors, and so that's kind of a big deal too, depending on what you're looking for. But if that fits the molds for a goal, then that's one way to go. Another vehicle you can go into, life insurance. Last couple slides here as we're finishing up. Life insurance has been used. I know you guys, some of you guys you've heard about this, or somebody's tried to sell you a contract, maybe. But life insurance can be used as an option to place premium and take out you can take out your principal tax-free, since it's dealt with post-tax money, and potentially take loans out of the death benefit tax-free as income. So that's definitely something to look at as tax exempt status. Big things to consider there. Same thing as annuities. There's lots of different types of contracts. You have to have somebody that is versed in those. I mean, even me, like, I know a lot about them, but even then I'll bring in an expert here and there to make sure that I'm doing right in those. And so when you're dealing with those, you always want to look at the expenses in those contracts. What are the loan rates potentially on those? What are surrender periods? Some of those come with surrender periods, maybe 5 to 10 year surrender periods, meaning that it might come at a cost. There might be a sales charge associated with getting out of those contracts if your goals ever change. So you want to look at all those things and make sure you're really set before taking those steps. Really into any investment, but especially life insurance. But that is an option, right? So you can do those. There's lots of different types of contracts out there. And so you can talk to a professional, like a financial professional, at least somebody who has lots of different wholesalers talking to them, all right, trying to learn them up on this stuff. But that's one way to go too. I'll show this. This is always really good for me. Tax advantage growth, or the advantage of tax deferred growth, excuse me. And so if you look at this, it's because you'll have some opinions. People are like, why would I go tax deferred? Why wouldn't I just keep it in my taxable account, my retail account, or why wouldn't I go here and there? Well, tax deferred vehicles show a lot of power. So you'll see on this graph, all right, somebody puts $100,000 in initial investment, has just a hypothetical 6% rate of return, and they fall in the 22% tax bracket. Well, if I'm in a taxable account, after taxes, that comes to after 20 years, 6% growth comes to $241,000, just over. Well, if I'm in a tax deferred account, well, the total portion of that comes to over $320,000, almost $321,000. I mean, you're talking, almost $100,000 difference of change there. It ends up being a big deal, right? And so I would you might want to look at some of those for those reasons specifically, if they match your goals. But I just wanted to show this because this could be a pretty motivating piece also. It's the same reason I participate in my 401k players as a player to reduce I was in a high income bracket. I wanted to reduce my adjusted gross income and deduct that off the top of mine, and I wanted to defer it for a long time growth. So that has a long time when I was in my 20s to cook till 59 and a half. So a lot of deferred growth there, which ends up being a really powerful tool. So there's lots of different things there. I'll go down. Does anybody have any questions? I'm gonna try to look in the chat box here and see if you guys have any questions here. I don't have any chat and chat boxes, but before we go, I want to give you guys a chance, if you got any questions, to holler them out. But if you got any, now's the time to do it. So you can chat box, or you can unmute yourself and holler at me if you guys have any questions right now. So I'll give you a shot. But I have a few others queued up as we go through things that might have come up. So somebody might be going through this, and I have a couple questions here. So you got a 2-income couple with kids. How do we take advantage of all available tax credits and deductions? And should we max out our 401k plans? Well, there's a few reasons you could do that. You could max out your 401k plan or go to a deferred bucket if they have school-age children and they're looking at potentially affecting their FAFSA funds for anybody who's filing for school aid or Pell Grant money coming into that. That can be an option because they look at income in cash. They do a 2-year look back on your taxes for that. Another question, let's see, a couple nearing retirement want to know, how do we allocate our assets for the best tax advantages? Can we gift assets to our children in the most tax effective manner? I didn't go over a ton of that. How do we allocate our assets for the best tax advantages? These are questions that come up that you might want to have a mix of some of these tax exempt and tax deferred methods. Right? They might not be using, somebody who's 60 retired might not be using a portion of their assets for at that time when they're 60. They might be using it when they're 70s, might want to defer to that period. So that might be a use of that. And how can we give assets to our children in the most effective manner? I'll go over some of that next month on the webinar too, with gifting assets. Right now, the limit is $15,000 per year per person, up to the lifetime exemption, which at the time, right now, is $11.58 million from the Tax Cuts and Jobs Act, which is the $10 million plus inflation is what's happened since that was implemented. That's anticipated to go down. So this might be a relevant question. So these are good things to ask. So you might put these in some of these buckets. Can I gift assets to our children in the most tax effective manner? Well, if I'm looking to gift, maybe I do look at a life insurance if I qualify for that, or maybe I go into another tax deferred vehicle in annuity with a death benefit rider. So it depends on the person and the point of the gift and the point of the fund. But those are a couple ways. Let's see, another single parent small business owner. Can tax advantage investing help me manage my tax burden, and what retirement plans are available for small business owners? So tax advantage investment can help the tax burden. As you guys see, 401k, right, I deduct that off the top of my income for this year. That's a big deal. And then what retirement plans are available for small business owners? I'll deal with, there's simple IRAs. It depends on the structure of the company. There's self-employed 401ks. There is smaller 401ks for companies with employers. There's SEP IRAs that you can take advantage of. So there's some different things. There's a lot of different tools to take advantage of. And like everything, look at the expenses associated. But there's lots of different options out there. I've implemented plenty for small businesses. So always a good place. So appreciate, I'll answer any of those questions. Let's see, a guy likes to do his taxes online, but wonders, am I realizing all the tax benefits available to me? Are there changes in tax law that might affect my situation? A lot of those softwares are usually pretty good. But I would say if there's question, if you have a little more complicated return, meaning let's say you got multiple 1099 divs, you have a couple businesses, you have several different income streams potentially. So there's a lot more tax versus just, a single W-2 wage earner. So they get that at the end of the year. They file the taxes, pretty simple there. But if you have any more than that and you had questions, talk to a CPA, talk to somebody who's qualified, or accountant of some sort. And then the second question, are there changes in tax law that might affect my situation? Right now, as we go into this new Biden administration with the proposed tax laws, what they're looking at for estate taxes is reducing that exemption down to $3.5 million, the estate tax, and raising from that 11.58 down to 3.5, and potentially raising that 40% tax rate on anything above the exemption to 45. Also, you guys might have heard the administration wanting to raise anybody above the 400,000. There's been some question about whether that's married filing jointly or single filers, but taxes raising for anybody in that category, and potentially long-term capital gains going away for anybody earning over $1 million in income. So if you fall in some of those categories, yeah, there might be some things that affect your situation, and you might want to take advantage of some different vehicles, and you want to exercise or look at those options carefully. So I would look at that stuff for sure. But all in all, these answers, it depends on the situation. And so, this is not a recommendation for any one single person or for every person out there. This is something for everybody to take in mind, just to let you know some tools out there and things to be aware of. I would encourage you guys to really listen to these new tax implementations that come out. If you already have a CPA, talk to them about it. If you have a financial advisor, talk to them about it already. If you want to talk to somebody about it, I'm available always. But these are important pieces that really affect our investment portfolio. And so make sure that you're not just relying, you're doing some research and you're talking to somebody, at least a professional who's been down the road a little bit about it. This is a crucial piece. Come to the end of this webinar. Man, thank you so much, you guys, for showing up. I wanted to flash my information up here one more time. My site, I am totally proud of my site. I love it. Go check it out, procapitaltx.com. It looks sleek and it's functional and it does a lot of good stuff. So I like it. But and then you guys should be getting emails from me, but I will send this recording out to you also after this, probably here in the next few days. So you can expect that in your inbox. But if you guys don't have any questions right now, I'm gonna sign off, and I'll let you guys get back to the day because we're about at the top of the hour and it is time to eat, and Big Boy wants to go eat. So I appreciate you guys showing up, and we'll see you later.